What's up, everyone? Welcome back. I just put out my first video yesterday, and I realized after I did that, I was like, man, I should probably do some kind of an introduction video because obviously some of you may not know who I am. I'm sure a lot of you are family and friends and know plenty about me. So, just skip this part if you don't want to. If you don't want a recap. But this is all about me, who I am. This is my beautiful family, my lovely wife, Nika, all of our kids. So together we have six kids total, and they are a blast. They are exhausting, but they are the most rewarding and wonderful thing in our lives. So that's the whole herd right there. I am a soldier. I'll move this out of the way so you can see. Been in the National Guard for almost 17 years now, which has been pretty rewarding, pretty amazing. This is actually a picture from Morocco, one of the cooler trips that I've been on since I've been in the National Guard. I am a personal trainer slash wannabe bodybuilder. That is my competition, my first and only competition so far. I did last October, and then I'm a dog dad. We got a whole herd of bullies, so we actually have six dogs total. This is just the bully portion of the herd. So you got Brisket, Donut, Bagel, and Fritters, the little guy there in the front, the puppy. And then we have a Staffy, and he's our old man dog. He's like, I don't even know how old he is. He's 15 or 16, but he's a great dog. And then our German Shepherd, Marshy. So just wanted to real quick, do a quick overview of who I am. This is one of my portfolios. Just a screenshot from Snowball Analytics, just something that's really fun to be able to track your trading, investing. So that's a screenshot from that. And then I love the outdoors. I love being outside. I love traveling. This is actually a picture from Kentucky. We went on like a steamboat river cruise tour when we were there, and it was a lot of fun. And this was a beautiful sunset over the river that I had to take a picture of. So really fun trip. I knew Kentucky was so fun. So I want to do a little bit of a deep dive into my system, what I focus on, what I've learned over the last almost year trading. These are rules that have helped revamp my system since I started. When I first started selling options, I think a lot of people, a lot of traders, they realize pretty quickly, like, oh, I can make a decent amount of premium selling options, and they get a little overzealous. They get a little greedy. They start chasing. They start FOMOing in on hot stocks or high beta stocks, and that works for a while, especially in a green market like we've had the last 6 months, but that doesn't tend to work over the long run. And unfortunately, I've had to learn the hard way. At least three times this year, I've lost $10,000 and then earned it all back, which is the good news. Bad news is I had to learn that lesson the hard way a few times. So the whole point of showing you the system and following me and doing this journey together is you don't have to make those same mistakes. That's the good news, okay? So we're going to focus on some key rules that I have now set in place that I follow that help keep my trading profitable, consistent, and actually pretty safe. So first and foremost, you got to love the stock. There's no point for you to be trading, selling options on stocks that you don't love, because one of the things that'll happen when you sell options is you could potentially be assigned that stock. If you're selling a put option and you pick a strike price and you pick an expiration date and the stock comes down and you get assigned, now you own that stock. Now, it's actually a good thing to get assigned, especially if you love the stock, because now you can sell a call against it and make more money on the upside. But you got to love it in the first place to believe in its value and that it's going to continue to go up over time based upon the fundamentals of that company. So that's rule number one. Rule number two, don't be greedy. Okay, like I said, you can very easily find really speculative stocks, companies that have very high premiums. You're talking 10 to 15, 20% premiums, and that can be very attractive when you first start selling options, but you'll find out pretty quickly that options are priced based upon volatility, meaning that the higher premium paying stocks are usually, they move up and down a lot, but also there could be some kind of catalyst in the near future, like earnings or a merger or something like that is playing into that option pricing. Okay, so you got to be aware of that. So usually if you see really high premiums, there's a reason why those premiums are high. Usually the higher the premium, the more risk you are taking on. Now, again, the risk is getting assigned, which is not a bad thing as long as you like the stock and you have a system that helps keep you safe. Because what you want to have happen is when you get assigned, you want to be assigned near where the stock is currently trading. Okay. You don't want the stock to have some kind of crash or black swan event and the stock drops 20-30% and you get assigned 20-30% above where the stock is trading. It makes it, not that you can't recover from that, but does make it a little bit harder. And if you're new, it could be, it can be scary, it can be terrifying. So these are things to be aware of. Have a trading plan. Very simple to have a trading plan. And we can go, in the future, in future videos, we're going to go over that. We're going to see what that looks like, how to execute that. More or less a flow chart of if XYZ happens, what do I do to adjust? That's what your trading plan needs to consist of. And last but not least, think like a long-term investor, not a day trader. There's nothing wrong with being a day trader. It's just that most traders aren't profitable in the long term. 90% of traders statistically can't beat the S&P over time in the long run. So with that knowledge, front of mind, it helps really kind of shift your thinking from being a trader to an investor. If you buy an asset and again, you love that stock, you love that equity, and you're fine with holding it for the long term, especially knowing how to sell options, you can create cash flow against that equity as you wait for that capital appreciation, that long-term growth, then there's nothing wrong with it. That's kind of the beauty of the system. That's the beauty of selling options. So we'll get into all that. It's the more exciting stuff that I really love to talk about. So the power of compounding. 2% a week. I know it doesn't sound sexy. You're like 2%. Why am I even watching this? Tanner, you're wasting my time. I get it. I thought the same thing when I first started selling options, but hear me out, okay? 2% a week is 8% a month. 8% a month is like almost 100% a year. So if you annualize that return, now it looks sexy. Think about how much, I'm sure most of you have a 401k or an IRA or something like that. Think about what your return has been in the last year, 2 years, 3 years, 5 years maybe, okay? Look at that return. Generally speaking, the S&P 500 returns 8 to 10%, 12% on a good year. And you're talking, that's an annual return, okay? Now, again, the S&P 500 is like, that's the 500 all-stars of the economy, right? So I don't want to make it sound like the S&P 500 isn't a good investment. It's the best investment. But then that's what most traders gauge themselves against is the S&P 500. But again, 12% on a good year versus 100% from selling options. I mean, that's a no-brainer, right? So real quick, just to show you kind of what that looks like. So let's say you have $10,000 to start investing with, and you get 2% a week, and that compounds weekly over the course of a year. And then let's look at a 10-year time horizon here, because again, we want to think like long-term investors. You're looking at taking your initial $10,000 investment, turning it into almost $300,000. Now, where this gets wild is let's just play with the numbers here a little bit because it's fun. Let's do 12 years. All of a sudden, do you see what happens? There's a shift in the math where the majority of your growth comes from, your contributions, your investment, that 2% return weekly that compounds, but it quickly shifts once there's enough money compounding. It quickly shifts to where now the compound interest is the main contributing factor of your growth, your wealth. So, and again, if you want to get even wilder, 15 years, now you're looking at $51 million. Now, I know that sounds crazy. I get it. I understand. But the math is sound. The math doesn't lie. And again, that's why I want you to think about this more of like a long, I want you to think more like a long-term investor. You shoot for that 2% a week. So if I'm trading on a stock that's $1,000 for 100 shares to sell an option, I'm only, I'm looking for 2%. That's $20 in a week. Now, again, you're thinking like, that's not sexy. But again, if it's $10,000 that you have as your initial investment, that's $200 a week. That's $800 a month, right? That's over $8,000 a year. So you can kind of see how this maths out. Again, These longer time horizons, they allow for a natural dollar cost averaging approach that smooths volatility in your portfolio over time. So as you choose these safer options to sell, going for that 2% a week on stock that you love, naturally over time you're going to dollar cost average your way into those positions. It's going to smooth out the volatility, and long term, you can have capital appreciation and cash flow all happening at the same time. So you're talking about exponential growth here. And that's why we stay long-term minded. Probabilities are on your side. You think about all the crazy crashes, market crashes, corrections that have happened, even in the past 20 years, right? You've got the dot-com bubble. You had you had the 2008 financial crisis. You had the coronavirus crash. Last August 2024, you had the Japanese yen trade crash. So all these market events that have happened, and even this year, right? This year, April, tariff crash. Okay, what happened every time? The market recovered and rallied to new highs every time, 100%. Those probabilities are what you put your money in, right? You put your money in those probabilities, that long-term return that 100% of the time the market's going to recover and is going to have growth and go to new highs. So let me explain to you why selling options is safer than you think. So in talking with a lot of people over the course of the last year, obviously I've been pretty excited about this because of how it's changed my life. And so I've been sharing with family and friends, and there's a lot of fear. There's a lot of fear in taking that leap and starting a new system. And granted, there is a lot to learn. And that's why I'm starting this channel. So hopefully I can help people learn slowly. I can coach them through it. I can help them get started so that they don't have to feel like they're alone in this, and that there's a lot of knowledge and wisdom they can gain from watching my personal experience. But what I think is risky versus what society thinks is risky is very different these days. And I thought the same way beforehand too, before I started selling options. But for example, nowadays you look at the rate of inflation, you look at any of the cars you want to buy that are new these days are $60, $70, $80,000 or more. You're looking at what, 10, 12, 15-year loans on cars, home prices, interest rates. That's what I think is risky. What I think is risky is putting my money in a money market fund that at the height of, this last 5 years was a 4% return, just having my money sit there and make 4% versus me being able to sell options and create 2% on my money every week. Which is more risky, or not even keeping up with the pace of inflation? You tell me what's more risky, right? I mean, if you have an IRA or a 401k and it's returning 4, 6, 8% a year, and you have to work for 30 years to get to a point where maybe you can retire. Just to give you a little personal story, my dad, he's been working his whole life. He's at the point now where he's thinking he can retire, and with him being able to do that, it's mostly because of the hard work that he put in. Him and my mom, they completely renovated their home. It was an older property. They put their money into, renovated, did all the work themselves so they could come out on the back end with not having a mortgage, and they're debt free. So that is the only way for them after the last 30 years that they can retire, was putting in a lot of sweat equity, making sure all their debt was paid off, and potentially looking at maybe being able to, follow that 4% rule in retirement. That's what most people are facing, is a 4% allotment of their 401k that they can sell to create income to live off of for the rest of their life. That sounds pretty risky to me, working 30 years, hoping that maybe you can retire. Maybe Social Security will still be there. Maybe you can cash out that 4% and maybe you can retire. I don't know about you, but hope's not really a great strategy, right? Wouldn't you rather have something a little bit more concrete that you could fall back on, something that you're controlling yourself? That's just my opinion. That's how I look at it. I would much rather be in control of what my money is doing versus just hoping that maybe in 30 years I can retire. So another great thing about options is there's defined risk, right? So if you're selling an option on a equity, and the share price is $20, it's 100 shares you're controlling, selling that option. That's a $2,000, risk you're taking on, right, to gain that premium. Worst case scenario, you're going to own that stock. And if you follow the system that I use, you're going to own that stock right around where that stock is trading. When you get a sign, you're going to turn around and sell a call against it to make more cash flow. And eventually that stock's going to get called away based on selling that call, and you're just going to start that whole process over again. You're going to rinse and repeat, and you're going to keep making money. The other upside here is you get paid to own equities you love and create cash flow when you own them. So again, the whole purpose is, and this is the simplest strategy that I employ. It's known as the wheel strategy. It's very common in option selling. You can search on YouTube, Google, and find hundreds of examples of how this works. Okay. Now I do the wheel strategy a little bit different. My strategy involves not only selling options to create premium, but also taking those premiums I receive, putting them into a brokerage account, and then investing them in high yield income ETFs and or growth stocks to gain capital appreciation and equity to be able to benefit from margin. Okay. And we'll get into all that later. I want to keep things simple. I don't want to overwhelm you in the first couple of videos. So again, that's kind of the whole point of the system is you're getting paid to own stock that you love. And then once you own it, you get paid to own it and potentially sell it higher than when you bought it. That's the whole point. So last but not least, this is very important, very important. Have a trading plan. Whether you're creating a trading plan with me or you're doing this on your own or you're experienced and you're creating your own trading plan, stick to that trading plan. Okay, the market, even though statistically over time does go up, crazy stuff can happen. If you look at the market the last 2 weeks, right, we've had a bit of a pullback. I think we're down total 6 or 7% on the QQQ versus where we were trading at the end of October, right? At end of October, all-time highs, S&P 500 QQQ. The next 2 weeks, volatile. There's been some macroeconomic factors that have taken place as far as like whether or not the Fed's going to cut rates again in December, and a couple other things going on. Markets pulled back 6-7%. Okay, that happens. That's part of the game. That's normal. So knowing that, you have to be prepared when that happens because it's going to happen. I mean, you can revert back even just to April where the market tanked 20%, right, because of tariffs, and then it went all the way back up to new highs, and now we pulled back 5%. It's normal. It happens as part of the game. So whatever your trading plan is, you should have it, you should stick to it, and don't panic when volatility strikes. What most people tend to do, or I shouldn't say most people, a lot of people, is that fear hits, that panic sets in, volatility spikes, they sell. They sell their positions. They think, oh, I'm going to hurry and sell before this gets worse, and they're already down, so they sell. What happens? The market rebounds, and now they have a realized loss. When you could have just had a paper loss, bought more on the dip and waited for the recovery and then exponentially grown your wealth because you bought more shares at a cheaper price and you dollar cost averaged into these, again, stocks that you love. That's the whole point, right? Rule number one. So that being said, I just want to end with a very pivotal quote. If you have any experience in trading, you've definitely heard this before. And if you've never heard this before, I want you to remember it, okay? Be fearful when others are greedy and greedy when others are fearful. That's from Warren Buffett, one of the greatest value investors of all time. Okay, so something to live by when you have these pullbacks, when volatility spikes, when there's fear. Those are the best times to buy because everybody else is afraid selling their positions and creating cheaper prices for you to gobble up. So thank you so much for taking the opportunity to join me for this. And I hope you have a great day, great weekend, and I'll be putting out more here soon. And please leave me some comments, give me a like, subscribe if you are interested in this content and you want to follow along or you want to get started yourself. And I'll talk to you later.